the next session is highlight of today's event. Here with us is the founder and CEO of Arabesque Asset Management. Arabesque has pioneered a new approach to asset management by integrating ESG data into the unique fundamentals and quantitative investment strategies to the big data and machine learning technologies with the aim of delivering long-term performance and reducing portfolio risk. Arabesque's mission is to make sustainable and responsible investing attractive and available for everyone and to empower people through the transparency of data. Today, he will address the trend and significant role of sustainable investment, and he will also share his experience on the sustainable investment, advancing your return and growth. Please welcome Mr. Omar Selim CEO of Arabesque Asset Management on the stage.
It is indeed a great pleasure and an honor to be here in Bangkok today. When I was asked to deliver the talk about sustainable and stable finance, I immediately said yes because I love your country and I can only congratulate you for what you have achieved, particularly in the space of sustainability, in the context of other countries. We'll share this in a moment. They say any good speech can only deliver 3 messages. What I want to do today is I just want to deliver one message to you. So there's only one topic I would love you to take home. And I want to embed this question into a wider topic. I want us all to think about the following. What do you think will be the biggest bank in 10 years? And unlike what you might expect, I'm going to ask you tons of questions today, so please you have to interact with me. So everybody has their favorite banks. Raise your hand and tell me which bank do you think will be the biggest in the world in 10 years' time? Go on. And if not, we're just going to throw some names at you and you raise your hands. Maybe it is UBS, maybe JP Morgan, maybe a Chinese bank or Japanese bank or an Indian bank. In my view, it's going to be none of those. In fact, I think the biggest bank in 10 years is going to be either Google, Apple, or Facebook. I believe that we are standing at a point where financial institutions are going to be revolutionized. And I believe that sustainability and ESG will be a key factor in this. So what I want to achieve in the next 1 hour or so is to change your perspective on sustainability from something that costs money, something that you do for ethical or moral reasons, something that is maybe backwards looking, into something that is a new tool, a new dimension, a new way of asset management, a new way of finance altogether that will revolutionize the way how people think about their money. So bear with me for this next 1 hour and I'll try my very best to explain this to you. But before I do so, I need to explain the name Arabesque. I was asked, what does it mean? And many people associate many things. When I'm in London, people think it's a restaurant or coffee bar. I have all my friends keep sending me these posters and pictures from shisha places called Arabesque. Say, did you open a new branch? I said, no. My daughter thinks it's a ballet position. Some people think it's a movie. What it actually is, it stands for art that is based on geometry and mathematics. So whenever we see a piece of art that is not based on human intuition, like a picture or drawing, but a piece of art that has symmetry in it, it is actually called an arabesque. And we have this most beautiful example just here behind me on this wall. This is a typical arabesque. It is art based on mathematics. What I will try to explain to you is that in this art, there is information. What our firm does is looks for information in patterns. And I give you one simple example so you remember this name forever. You know the numbers that we use in the English language. Does anybody know why they look the way they look? And there's a reason for that. I'm going to make it very simple. It is the number of angles. So if you see a 0 has no angle. You see a 1 has 1 angle, a 2 has 2 angles, 3 angles, 4 angles, 5 angles, all the way to 9 angles. That is the simple logic behind numbers. So I'm trying to tell you is that there is an information hidden in the form. And what we learn, and ESG is a key element in that, is that there's information hidden in patterns of information and big data. And that is what I believe, which will give Google and Apple and Facebook the edge over the conventional banks. We were founded as a management body from Barclays. Barclays sold BGI to BlackRock, the world's biggest asset manager, to the world's second biggest asset manager in 2008 as a result of the financial crisis. Barclays had a 5-year non-compete, and I was fortunate enough to be part of the team that reconsidered asset management. So we had a task group that were thinking, how will finance look in the future? And we did a lot of studies and research around this. And what we found is that the two most important elements are sustainability information and big data. And we will show this in a minute. I need to explain myself as well, by the way. So I am half German, half Egyptian. I was asked about my German accent and my Arabic name. And my friends always say, this is a combination between an Egyptian and a German bike, but it is not. It stands for sustainability with power. So let me tell you, what is sustainability not? Sustainability is not about imposing moral or ethical principles on other people. We don't do this. We simply create transparency. Secondly, it's not about greenwashing. You cannot abuse it just to hide something that is not correct. In other words, if you produce as a corporate your products and your services in a way that is not in line with human rights or labor law, environment, and anti-corruption, it doesn't matter how much kindergartens you build and how much CSR budget you have, it's just going to make it better. Thirdly, it is not something that we do at the expense of performance. It used to be like this because it was an industry exclusion approach. In other words, when sustainability started 10, 20 years ago, and people used to do it because I think I'll take out alcohol, weapons, tobacco, gambling companies, and then I'll reduce the optionality of the portfolio, and then the performance automatically will go down. But this is not the case. It is a technology that has evolved to something that will generate performance. And the last point about sustainability is it cannot be kind of like a mixed thing. You cannot be unsustainable Monday to Thursday and then on a Friday you're sustainable. You cannot be a producer that does not respect sustainability efforts in some products and does it in others. Either you are or you are not. So what I want to tell you is that we believe there is a silent revolution happening in the financial industry. It is partly based on that nobody's really happy with their financial services. Raise your hands if you love your bank. If you think your bank is a good person. You know, people are overcharged, underserved, generally unhappy. It's just opaque. The language, people don't even understand in finance. It is intransparent, and we believe this will change. It's a global movement. There's a growing support for the business case, particularly on the corporate side. They understand that if you manage your business long-term sustainable, you will outperform your competitors. You can always cut corners for 1 or 2 quarters, but at the end it's going to come back to you. And there's a lot of regulatory changes pushing investors towards sustainable investing. And of course, there is a very important role on the reporting and the stock exchanges side that lay the ground for sustainable reporting. So the analogy I want to leave with you is sustainability in finance is what the electricity is doing in the car industry. Well, let's think about this for a moment. So we have, fossil fuel-based car for over 100 years now. So they're driven with gasoline or diesel, and they've been doing well, and that's the vast majority of cars. And having electric cars for like 30 years or so, but they didn't go well. Nobody bought them, they're not going so fast, they looked ugly, they were something for nerds. And something has happened. What did Tesla do to the car industry? They did 2 things. They made electric cars go like a rocket, and they made them cool, they made them fun. And now you can see this enormous change in the whole car sector industry. Everybody's moving to electric cars. There's laws coming in place. 2030 in the UK, in France, in Germany. There are going to be laws abandoning conventional cars for electric cars. Now, interesting, you would have thought that the big car companies would have thought of that. They would have said, wow, are we going to be the first? Mercedes or BMW or the other Germans or Japanese or providers? They did not. It was an American company, Tesla, which revolutionized the car industry. And you will see the same happening in the financial industry. There is a giant demand for sustainable investing happening at this moment. The banks are a little bit slow, so maybe other smaller companies will overtake, but there's definitely a significant movement. So now let's look at what will happen to the industry. What is disrupting the whole financial industry? And we've written down a few things, so I don't want to talk about quantitative elements, but the most important one for me is the zero interest rate environment. Now, what does it mean? We have 5 asset classes. We have fixed income products, rates and credit, and we have equities, we have real estate, commodities, and foreign exchange. So your money is inevitable in one of these 5 categories. 60% of the world's money sits in fixed income, mainly in government bonds. US treasuries, gilts, JGBs, bonds, whatever you want to call them. But what we have in the documented history of mankind for the first time is an interest rate environment that's almost zero. So we can go back 2,000 years and we can look into people complaining about too high interest rates. But we never ever had almost zero. In fact, the country where I come from, Germany, has negative interest rates. You put your money with a bank and you're going to get punished. That is a complete new scenario. So the only thing you can do, and remember that fixed income is the only asset class that has a theoretical maximum price. So if you invest in a stock or real estate or commodities like gold, the price can be whatever the buyer and the seller agree on. But in fixed income, there is a mathematical function that when the interest rate scenario is zero, it hits the end. The price hits a glass ceiling. A 5-year bond with a 6% coupon, when it hits 130, that's the max. So ultimately that means that we're going to see money moving out of fixed income into other asset classes. That's why we have an all-time high in many stock exchanges. That's why we have such high property prices. It's because they're the 2 biggest asset classes that is constantly taking money from fixed income. Why would you give your money to a government like Germany or the US or others, and you have an interest rate, a coupon that is maybe 0 or 1% or 2% for 10, 20 or 30 years? Why would you bother? You know? So you have no choice but actually to put it into other asset classes, and the next big asset class is equities. And if that is true and we're going to keep continuing more and more money into stocks, that means that the spirit of investing will change. Because in fixed income, you're risk transferring. In equity, you're risk sharing. You're aligning yourself with the corporate. And that will push the ESG agenda. If I'm a fixed income investor, really I don't care about ESG, right? I just want my money back. But if I'm an equity investor, I really care about how the government, how the governance and the sustainability of the company is and how it is run. So one big disruptive element will be equity is the new fixed income, which over the next 10 years will push money towards sustainable investing. Next one is, obviously there is a new banking model, savings model. The whole pension system will be affected by the zero interest rate environment. And then we have 2 very important elements. One is ESG data. So there have been maybe 5 good years of integrated reporting. Before this, we did not have the information. Companies just did not produce information about water consumption, energy consumption, wastewater management. Now, actually, for the first time, you have this significant amount of corporate reporting, particularly driven by the stock exchanges, like in Thailand, like in Singapore, or like in Malaysia. And with that, there's the other element, which is the capacity to process big information. So now we have artificial intelligence, we have machine learning, we can process billions and billions of data points without a problem. And we don't just process them, we can intelligently look through them. So it's a new way of processing data that is now available. And finally, it's something that I like to call the lifestyle feeling of finance. Raise your hand if you think that you have any emotional connection with your money. And that's a weird thing, because let's face it, money is an important part of our life. We work hard, we earn money, we have it in our pensions, in our savings for the children, for a lot of things. But who really knows what his money is doing. What is your money doing? Maybe it's doing exactly the opposite of what you want it to do. There's this really interesting case in Australia of Dr. Brown. She is one of the leading oncologists. So she heals cancer. And when recently she was asked to overlook the pension of the hospital she worked in, she found out that the vast majority of her pension money is invested in tobacco companies. She said, how come I worked all my life to fight the results of tobacco consumption, and my money is doing exactly the opposite? So that's something really important, which we believe particularly the millennials will push for. They want to say, I don't want my money to be bad for the environment, to be involved in human rights violation, to be fighting efforts for good governance. My generation used to ask, how much money will you make for me? What's the return? What's the volatility? What's the Sharpe ratio? The next generation will ask this plus, how did you make that money? At the expense of child labor, corruption, pollution? I don't want it. I want sustainable money. That's a huge movement, which banks will struggle to deliver on. So let's dive into the two key elements a little bit deeper, ESG data. So fact is that 90% of all information is less than 2 years old. Just imagine, in the whole history of mankind, 90% of all the data that we have today is less than 2 years old. What an exponential explosion of information. That doesn't mean it's all good data, but it is a fact that we now have a new set of information available. And the other element is the ability to process those data. So we at Arabesque, we process over 100 billion data points about corporates. So in other words, historically, before 5 years, we only had financial information available about companies. Now we have so-called non-financial or extra financial information available. How does the company treat its employees? What is the wastewater management? What is the water consumption? What is the electricity consumption? What is the board? What is the structure? Everything is now available. Everything comes out through big data. And nobody can escape that. So as an investor, we now have a new set. It's like a new lens available. It's like, the invention of X-ray in medicine, where you could historically only look at the patient from the outside. But now you can look at the patient from the inside. And as an investor, we can now look into a company from the inside and get much better information. What it does particular is to protect us against tail risks and reputational risks. So the sudden unexpected events. So we at Arabesque, we did not invest, we excluded through our technology the Volkswagen scandal, Toshiba, Tesco, Sun Edison, Violent, all of these. We could not predict the environmental scandal of Volkswagen. We could predict a governance issue at Volkswagen, which led to an environmental problem. And who would have thought that the world's biggest producer of solar panels, Sun Edison, would have issues on the accounting side? Again, only if you look into governance issues, you would have spotted those. So ESG is actually nothing else but a technology to assess the management of the company. I want to spend one more moment on this. And one good example I like a lot is if you take a copper firm, a copper company. So you want to produce copper. And I give you a choice between company A and company B. If you need to split the copper from the stone, you need a dioxin. You need, obviously, which isn't a good thing for the environment. And I give you company A, which will recycle the dioxin and reuse it. And I give you company B, which is just going to rebuy the dioxin and just put it in the river. It becomes an externality in the environment. As an investor, I can tell you that this would cost about the same. You can reuse it or you can recycle it. Price-wise, it doesn't make a difference. It just costs you a little bit more at the beginning for the technology, but then you're going to catch up with that. So which one would you choose, A or B? And if I tell you it makes financially no difference, what it will tell you is that the company that is recycling is smart about challenges. It's an indication for what type of decisions do they take. It will be better for them to deal with the challenges of the environment. So that's just a very simple example. And we can take many, many others. AI is a is obviously one key element that is in the papers every day. And I don't want to go into any of that details, but I want to give you one simple example. So this, you remember that in '98, for the first time, a computer beat a human in chess. So Deep Blue was a computer from IBM, and the world champion was called Kasparov. And up to that day, never a computer beat the world champion. And on that day, the human lost for the first time. And the reason why is that they programmed the strategies and the roots of the game, and Kasparov can predict or preempt 12 moves, and the computer could preempt 14 moves. So he had not a chance. He lost. And 2 years ago, in 2015, a company, DeepMind in London, which is now part of Google, developed a technology that uses artificial intelligence and was able to beat the world champion in Go, a Korean gentleman called Mr. Lee, for the first time. And what they did is they did not program the computer to understand the game. What they did, they just photographed the game. And the computer learned itself and managed to develop a strategy and beat the world champion. And that is the major difference. So artificial intelligence today means that you can take any Atari game, strategy or whatever it is, and you can switch on a camera in the morning, and you can connect this to the computer and let the computer watch this game. And by the afternoon, the computer will beat almost any Atari game. It's a completely new world. It will affect so many things in our lives. It will affect the driving and Amazon shopping and how we use the internet and everything. It's a challenge, it's a risk, but it will for sure have an impact in finance. And as in many other industries like aviation, where if you compare a pilot in the 70s would physically fly the plane with a navigation computer. And today, a modern plane is flown by a computer. The pilot overlooks, the pilot steps in as he has to, the pilot mainly starts the plane, but the vast majority then gives it over to the computer and then lets the computer land the plane. Every fifth landing the pilot should do himself. But the point is that no human has the capacity anymore to fly a plane as good as a computer. If you speak to aviation specialists, they will tell you that they can sit and tell you when the computer is flying, when the human is flying. So that's where we are in many, many industries. So do we really think that finance will not change? Finance will change significantly. The days where an investor would sit in Wall Street or Mayfair in London, read the papers, talk to the brokers, buy and sell some stocks, it's over. The future of investing will be using big data, will be using artificial intelligence, will be using ESG information. So the key thing that you have to understand then is, what is the correlation between a company's performance on ESG and the stock price of the company? And here's the good and the bad news. The good news is, there's a study we did with Oxford University, which is well regarded in the market, that clearly shows you the evidence. But the problem is still two things. One is you need a significant, large enough data sample. It doesn't work when you take 2 or 3 companies and choose based on ESG. It doesn't work. You need like 100 companies, then you can do it. And the quality of information differs in the world. So in some countries it's excellent. In some countries it's just background noise. It doesn't work. So still there's a rise of ESG information, which will continue over the next years.